Welcome, ladies and gentlemen, from me, Guy Monson, Chief Investment Officer of Saracen Partners, to our regular strategy update. In this session, I wanted to concentrate on the results from financial markets for Q2, this extraordinary rally in equity and risk assets, which you've seen in this great financial recovery. But before I do that, I just want to remind viewers of the scale of the monetary and fiscal stimulus that lies behind this recovery. On the left-hand side of slide 2, central bank balance sheets expanding by an extraordinary 5 trillion in just 14 weeks, 3 times the rate of stimulus we put in 2008-9. Hardly surprising you've seen some rebound. On the right, you see the same for fiscal policy. You can see roughly a 4% of GDP stimulus, unprecedented outside of wartime. Look where that number sits compared to the pre-COVID crisis bars. And I would highlight that light green bar in the middle. That's the UK, one of the largest stimulus programs. And we've added in there another 4 months of furlough as the government and the Chancellor extends the underlying scheme. And that's flowed into financial markets, flowed into confidence, and delivered a staggering recovery. On the left-hand side of chart 3, you can see global asset returns. World equity indices rebounding by nearly 20% on the quarter. Gold continuing to climb, obviously fears where this global stimulus finally ends. Government bonds remaining stable. Now that's unusual. You'd expect to see the government bonds sell off, but of course that's the extraordinary central bank support that lies behind them. It's not just equities. On the right, we've seen a big fall in the yields of corporate bonds across the UK, with a BBB rated bond coming down from 3.5 to under 2.5% yield, and A-rated down to just 165. Now, if we pulse back 10 years ago to the 2008-9 crisis, about this period after the start, those corporate bond yields were still in the 7s. Today, 165 for a single A-rated bond. Digging a little deeper into the equity returns, on slide 4, I've shown the returns by market. Now, the first thing you'll note is the extraordinary consistency. All up about 20%, S&P 500, world index, emerging markets in yellow. That's testimony, 1, to the effect of the liquidity across all markets, but 2, the fact we're not getting this dominant US leadership, which we saw before, a much wider response from international markets. You'll note in light blue at the bottom, still the UK underperforming. That's the asset mix, a lot of materials and oil companies, but also the discount that continues to be placed on UK assets over this Brexit period. On the right, you can see this liquidity also flowed into a staggering recovery in commodities. Brent crude up 60% from the chaos of negative prices of WTI, copper up by 26%, gold there up by 10%. I made one other point on slide 5 over the quarter. The dollar is actually modestly down. This is the DXY, the DXY, the dollar index, falling a couple of percent. That's very encouraging because that takes pressure off the emerging markets, Asia, the rest of the world, where there are large dollar debts. And we don't get that tightening of dollar liquidity we saw in 2008-9. All that on the right has contributed to lower equity volatility. The VIX back below 30, much lower numbers than we saw at this time after the financial crisis. And interestingly for us at Saracen, beginning to get into the range where we can redeploy some of our portfolio insurance. Now, financial markets have rallied strongly, Wall Street, but on Main Street, I'm afraid we're still facing very tough conditions. We've updated our economic forecasts and we still have the world now falling at 5.8% full-year GDP for 2020. Reminding you that's only the second time since World War II that overall GDP has fallen negative. Now you can see on the right, I've shown that in bar form, the fall off we're now predicting for 2020, 3 times the decline we saw in 2008-9. Now, just for reference, we're assuming that economies remain 25 to 40% shut down until the year end. And if a vaccine comes earlier, that might be too aggressive. But if we look at the infection rates at the moment, it's certainly not. I'd remind you rather depressingly on Johns Hopkins University numbers at 218,000 infections in the last 24 hours. That is the highest number that we've seen in the world crisis and the virus crisis to date. Record numbers again in Mexico and Brazil. We got some good news yesterday in the US labor market. Non-farm payrolls bounced by 4.8 million, taking them up to 139 million on the left of chart 7. But remember, that's still 50 million lower than at the pre-crisis level. The unemployment rate, again, better than expected at 11.1%. But remember, back in February, President Trump was able to boast an unemployment rate of 3.5%, the lowest in 50 years. In the UK and Europe, a similar rebound in sentiment on the left of slide 8. That's the purchasing managers' indications bouncing quite sharply. Interest the UK above 50. So a small majority of respondents expect better conditions compared to where they were last month, which is encouraging. But in a very powerful speech from Andrew Haldane a couple of days ago at the Bank of England, he just reminded us the scale of the drawdown. He plotted the distribution of quarterly GDP growth since 1955. There you can see those blue bars, the average observations between -2 and +2. Look at that number for the projections for Q2 at -24%. So we think there's still some permanent scarring and damage to be taken into account by markets. So what does this mean in summary? Well, we've updated our forecasts. We've moved underweight gilts. Why? Because at just 18 basis points yield for a 10-year and negative for a 2-year, they're not attractive to us. And we've moved more money into investment-grade corporates. I showed you some of those yields earlier. We're staying neutral in equities, overweight global, nudging up the UK a little bit to neutral to capture some of that value, still cautious on the emerging world. In alternatives, we remain overweight, particularly infrastructure and renewables, which I think can deliver these inflation plus returns, taking down a little bit of cash. So a far better financial picture than we dared expect, but I'm afraid still some real caution in the underlying economy and against this virus backdrop. Thank you.